Hello, the name is Osvaldo Antonio Nyaka, and welcome to another one of these short enlightenment videos where we discuss human behavior, look at universal principles around philosophy, psychology, as well as personal finance. The hopes of these videos is that you can take one or two things from the videos and then start applying it and implementing them in your life. And I must say, it's one of the things that I love doing that just brings me absolute joy. Today's principle is not a principle as such, but it's something that I've been studying for over 10 years in the area of finance. Now, I've read a number of different books on finance, and through reading these books, I found a common pattern around them. And this I personally like to call these the six money circles, where I found that whether you're an individual, a company, or someone who's evaluating businesses and companies, usually money will fall into these six different circles. And once you actually start to understand these six money circles, you're then able to also understand your own behavior and decisions that have to do with money and why you make those money decisions that you make. So the first three money circles that I want you just to envision are labeled assets. And what you want to do is you can just imagine three circles in a triangular format where you've got the one circle at the top and the two circles at the bottom. And then if you're drawing it out, you can link these with straight lines. And in the middle, you can just label it assets. These three circles, the first one at the top has to do with income. Income has to do with the money that's inflowing into your bank account, or perhaps if you're running a cash business or you get paid through cash for your labor. This has to do with the income. And maybe you might even earn a property or certain assets that bring in money on a monthly basis or quarterly basis or maybe once a year through dividends. What you want to then realize or put into your mind is the fact that this is the income that comes in. And on the bottom right hand corner, you can then, on the second circle there, label it savings. Savings has to do with money that you put into a specific bank account. The bank account then pays you back interest on that. And that's then the income that comes from that. Then the third part on the far left, we can label that investments. Investments are long-term income that you put money into different asset vehicles. One of them could maybe be stocks, REITs, ETFs. Those are long-term investments that are not easily liquidated. So under savings, you'll have money or things that you can easily liquidate. You can easily earn an income from them, and they're easily liquidated. Yes, they don't offer you the greatest return, but they are the safest. Whereas when you look at investments, you're not looking at things on the long term. So this, we're going to call them assets. So at the top, you'll have your income. This side will then have your savings. And then on the left, you'll then have your investments, labeled assets. Then you can draw the same structure, the same three circles, one at the top, bottom on the right, and then the other there, and then join them up, link them up with a straight line. And this in the middle, we're going to then label it liabilities. Liabilities have to do with the outflow of money. At the top, you're going to have expenses. Expenses are the things that take out your money every single month. Every single month, you know, okay, I have to buy groceries because I have to eat, or else if you don't eat, you'll starve to death. Expenses, where you're looking at if you're paying for your transportation or you're paying for petrol. These are the expenses that you pay for on a monthly basis. Then on the top right-hand corner, what you're going to then do is you're going to write down short-term debt or short-term liability. Short-term debt is anything between 1 to 5 years. Anything that you're paying off every single month that has to do with the time period between 1 to 5 years. Then on the far left or the left circle, you're going to label that long-term debt. Long-term debt has to do with all the debts that are 5 years and longer. These could be things such as your mortgage bonds, or perhaps you have a business bond that stretches between 5 years and more. So that has to then do with your long-term debt. Now, how do you make use of these 6 money circles? Before we get to that part of the 6 money circles and how to incorporate them, usually when I meet people and we get into discussions, and they usually bring up the topic of finances and money, and they usually say, well, I've got a hard time keeping money. And whenever money comes in, it goes out. And usually the first thing I ask them is, I usually ask them, well, what's your financial freedom number? And at first they look at me blank, like, okay, what do you mean by financial freedom number? And I always tell them that financial freedom number is the amount of money that you need to have today in either savings or an investment that could passively pay you, where you don't have to work for that income or for that money. And they look at me puzzled, and as they get the idea, they then say, oh, okay, well, I don't know how to calculate that. Well, the formula that I normally use is simple, is I normally tell them, okay, what is your ideal salary or ideal monthly income that you want to have every single month that would cover your daily expenses and your monthly expenses? And usually, this is actually a practical example that one of the people that I met actually gave me, and she said, okay, well, my monthly expenses or my monthly income that I want per month has to be 100,000 rand. Now, I will use the currency rands because the conversation was in South Africa and the currency is rands. And she says, well, I want an income of 100,000 rand a month. I say, okay, let's then take that, multiply it by 12, which then represents the number of months in the year. She took that, multiplied it by 12, then it worked out to be that she needed 1,200,000, so 1.2 million, that she needs to sustain her life throughout the whole year. Then I said, okay, so based on that number that you have, where is it that you have the highest clarity and the highest confidence, where if you had to put your money into that specific investment type or savings type, that you're guaranteed to get a return on it? And we went back and forth for some time. Then I said, okay, let's just make a practical use of a savings account. What's the normal going rate? And we use the going rate of 8%. And usually we can factor into it inflation, but for the sake of this example and for the sake of the conversation, I left out the inflation factor. And I said, okay, well, take that 1.2 million divided by 8% and see what you get. She took it, divided it by 8%, and she realized that the number that it came up to was about 15 million rand. And that 15 million rand that she came up with, I said, okay, so that means if you wanted to be financially free today, based on that 100,000 rand per month that you want, it means you need to have at least 15 million in a savings or an investments account that is paying you back an 8% return. And the moment she realized that, certain things came up. She said, oh, okay, so my goal is essentially not to take up my income, but my main goal is to build up enough cash into any savings or investments where it's 15 million and I get to live that asset-based lifestyle. Then she said, oh, okay, now I get the idea. Then the second thing that we then did is I then asked her, so on the monthly income that you get, what happens when you get that money? She said, well, I get an X amount of money, and the moment I get X amount of money, I then asked how much of it goes into the savings account. She said, well, a portion of it goes there, but it doesn't stay in there for long. I said, okay, no problem. Then let's then find out how much monthly goes into your investment. She said, well, I actually do high frequency trading in terms of I try to put money into things such as Forex, Bitcoin, and I end up losing my money. I say, okay, so that means whatever goes in there goes in and out quickly. So which means you're sort of far up the investment ladder. So you're taking big risks without necessarily stepping your investment knowledge and step in your investment exposure. I said, okay, no problem, that's fine. Then we went into the 3 circles that have to do with liabilities. And what we then found out is when she put down the expenses, her expenses outweighed what her income was. And she said, well, but I don't necessarily understand why I keep making these decisions. I said, no, let's carry on. Then we looked at her liabilities, short-term and long-term, and she had very high liabilities on those 2 circles. Then she said, well, why do I then continue to still make these decisions, these money decisions? Because I want to keep money. And yes, the simple truth to it is that the decisions that you make are based on the things that you believe will give you the highest advantage versus the disadvantages. So I asked her, where do you normally spend your money on? Where does your money normally go to? She said, well, I normally buy material things. I normally go out and buy cars. And this is where I normally spend most of my money because I love socializing. So that then told me and also revealed to her what a psychology is when it comes to money. So the moment she gets money, her first priority is to buy things, not to necessarily keep the money that she earns. And through doing that, she then realized that the things that she buys are more important than keeping money. And one of the things that I then helped her to do is to actually then say, okay, first, let's look at your psychology makeup as to why you make the decisions that you make. And we went in, discovered her hierarchy of values, and hierarchy of values were there. And it showed that money and keeping money was the 6th value that she had. That's why whenever she got money, she would always outspend it. Whenever she tried to save, she would then take it out because her value on having money and keeping money are very low in a hierarchy of values. Then she then asked, well, what are one of the things that we can do? And one of the exercises that I gave her that I would also actually implode you to actually do is to actually go in there and take the action of actually saving money and finding out what the benefits are of that, of actually saving money. So what you do is you actually write down what are the benefits to me of saving money and keeping a portion of my income. And the more you answer this question, the better you actually will start to see how this action has its benefits over spending the money on other actions. So what you're doing is you're taking the micro action of saving money. So whenever the income comes in, you save a portion of it. And you're finding out what the benefits of saving money, of that micro action in itself are of a benefit to you. Usually, I tell people in the program that I run, which is then the psychology of wealth, is on this exercise, we answer it at least 200 times. By finding out the 200 benefits of this specific action of saving money, you then start to rewire your brain and start to rewire your mind, because now you're starting to see money differently. And one of the things I always urge people when doing this exercise is don't look at the benefit of, okay, the moment I save X amount of money, it means I can go out and buy something. That's not what we're looking for. When you're looking for the benefits of this action, you're looking for the benefit of the action in itself, the benefits of keeping a portion of your income, growing it as it's piling up and as it's growing, which is separate from spending it and giving it out. Because what you realize is people that value money tend to pay themselves first, and then they go out and buy the things and support other businesses and support all these other expenses. Because the moment you outflow money, what you're doing psychologically is you're saying all these other things are more important than me. And psychologically, what will tend to happen is because you've outflowed money so much, by the time it comes to giving back to yourself, you're going to go and spend it on something that's pleasurable because of all the pains that you now have gone through. So the moment you start paying yourself first through a savings, you're then starting to redirect your money in terms of that hierarchy of values, and especially the hierarchy of what's most important to the money. So what you're doing is you're telling your money that comes in that I am the most important person. by having it into a savings program. And I know that most financial advisors will tell you, well, saving money is not going to make you wealthy. I've never met anyone who saved their way onto wealth. Well, that's true, but the psychological effect of paying yourself first and saving money is that you're redirecting your psychology and telling your psychology that, listen, I'm the most important thing when it comes to my money. And the moment you master your savings, which is something that once you put into a bank account, you are guaranteed an income from that, it then leads you to start learning how to master the other levels of investment. So very often we actually fed the idea that wealth is built by taking higher risks. But in actual fact, wealth is not just built by risk. Wealth is built by leveling up your different investment levels of investments. You master one level, you go on to the next level. So you start off with the savings. Then from the savings, you go into things such as your mutual funds. Once you start mastering these different levels, it gives you something to fall back on. Because if you're investing in high risks and you lose your money there, psychologically you're going to want to commit suicide. But if you have a safety net lower up that allows you to take higher risks, if you lose your money in those high risk investments, you've got something to fall back on. And this is what helps you to master your psychology when it comes to finances. So the moment you start to understand these 6 money circles, you'll then start to understand that the inflow and outflow of money are two equal opposites, where on the one side, you've got your income, and on the other side, you've got your expenses. And the goal is to take down your expenses, increase your savings and investments, so that your savings and investments are one day can be able to cover for that income, which that income then covers for your expenses and also covers for your short-term and long-term debt. So the moment you get rid of your short-term and long-term debt, all the monies that's going there monthly are then going into the asset side of those 6 money circles. And yes, it is a very broad topic, and it's something that we usually spend a lot of hours talking about to be able to understand it. But the key takeaways that I want you to take from this is that when it comes to finances, the moment money comes in, the key is to actually pay yourself first. And by paying yourself first, either through savings or investments, you're then rewiring your brain, and you're rewiring the conversation that you're having internally by saying that I am the most important person, and therefore saving a portion of my income and investing a portion of my income is paying myself first. And the second takeaway that I want you to do is perhaps go through and do that exercise. Do the 200 benefits. What are the 200 benefits of actually saving a portion of my income? The actual action of saving money. Not saving money to go spend, but the actual action of saving a portion of your income. And look at all the other areas of your life. The benefits to you socially, financially, spiritually, physically, mentally, as well as physically and vocationally. What are the benefits? Go around the 7 areas of life. And hopefully that would also make a difference. I know that it certainly has made a difference in my life. Every time I do the exercise, it just unveils and just changes the way that I see finances and money. And hopefully this will make a difference to you. And thank you, and I will see you next time.